Welcome to Course 15 of the MaxLife Commercial Academy, Self-Storage Investing. I'm Ryan Solberg, real estate broker with MaxLife Commercial here in Central Florida, and I want to tell you something that surprises a lot of first-time commercial investors. Self-storage has been one of the most resilient, lowest drama asset classes in all of commercial real estate for the past 20 years. In this course, we're going to break down how to underwrite a facility, how to find value add opportunities, how to think about ground up development, and how to use revenue management strategies to drive rent growth. Whether you're a seasoned investor or just getting started, this course will give you a real framework for evaluating storage deals. Let's get into it. So why does self-storage deserve a place in your portfolio? Let me define it first. Self-storage is an asset class where you rent lockable units, anywhere from small 5x5 locker to a large drive-up bay, directly to individuals and businesses on short-term, month-to-month leases. That simple structure is the source of all its strengths. Here's the headline that surprises people. REIT data shows storage outperformed office, retail, and apartments in 8 of the last 10 downturns. Why? Because the demand drivers are counter-cyclical. People accumulate stuff and need storage when times are good, and they downsize, divorce, relocate, and settle estates when times are bad. The industry actually talks about the 4Ds: divorce, downsizing, death, and dislocation. Those events don't stop in a recession. The month-to-month lease is another quiet advantage. Unlike a 15-year NNN, you can reprice your entire tenant base as the market moves, which makes storage an excellent inflation hedge. Then there's the cost side. There's no plumbing in the units, no HVAC in most of them, and minimal staffing, so expense ratios run a lean 35 to 45% versus 45 to 55% for multifamily. And here's the part that creates opportunity for investors like you. The ownership is still incredibly fragmented. More than 70% of facilities are owned by mom and pop operators who often haven't raised rents or gone digital in years. That fragmentation is exactly what makes the value add playbook so powerful, and we'll get into that next. Now let's talk about how you actually underwrite a storage facility, because the numbers tell you everything about what kind of deal you're looking at. The whole pro forma comes down to unit mix and rate economics, and the formula is straightforward. Net operating income equals units times occupancy times average rent times 12 minus your operating expenses. Simple to write down, but the inputs are where the skill lives. Let me contrast the two ends of the deal spectrum. A stabilized facility is running 85 to 92% physical occupancy and 90% or better economic occupancy. It has a balanced unit mix. Your 5x5s, 5x10s, 10x10s, 10x20s, and 10x30s. The spread between street rate and in-place rent is small because the operator is already pushing rates. There's a cloud-based management system in place. And in a primary market, that asset trades at a 5 to 6.5 cap. You're buying stabilized cash flow and you're paying for it. Now the value add target looks completely different, and that's where the money is made. Occupancy is sitting at 70 to 80% with clear upside to market. Rates are 20 to 40% below nearby stabilized comps. There are no online rentals, no revenue management, paper leases in a filing cabinet, and no gate code tracking. Because the in-place NOI reflects that mismanagement, you can often buy it at a 6.5 to 8.5 cap on current numbers. The art of underwriting is seeing the stabilized facility hiding inside that value add target and modeling honestly what it takes to get there. The mom and pop value add strategy is one of the most reliable playbooks in commercial real estate, and storage is where it works best. Here's why. The bar for institutional quality operations is low, and the gap between a poorly run facility and a professionally managed one is enormous. Let me walk you through the 4 levers. First, rates. Most small operators set a rate when they open and barely touch it for years. When you acquire one of these facilities, your first job is to comp the market. Pull every nearby competitor, look at their online street rates, look at what they're offering for move-in specials, and figure out where you sit relative to market. You'll almost always find 20 to 40% upside just by repricing vacant units to market immediately. Second is going digital. If a facility doesn't have online rentals, you are invisible to a huge chunk of the renter population. People rent storage units late at night, on weekends, on their phones. A cloud-based PMS with online move-in capability can meaningfully lift occupancy within the first 90 days. Third, ancillary revenue. Selling locks at the counter, offering insurance programs, renting parking for boats and RVs. These lines of income have almost no incremental cost, and they flow straight to the bottom line. Fourth is the physical plant. Security cameras, better gate access control, fresh paint, good lighting. These improvements let you command higher rates and attract the kind of tenant who pays on time and treats the facility well. Add those 4 levers together, and you can often double NOI within 2 to 3 years of ownership. Ground up storage development can be extraordinarily profitable, but it's also where a lot of investors get into trouble. The business model requires you to absorb losses during lease-up, which can run 18 to 36 months depending on the market. So before you commit to a development project, you need to be honest about the feasibility questions. Let's go through the key ones. First is the demand study. You need to verify that the trade area is not already overstored. The rule of thumb is 7 to 10 square feet of storage per capita as a national average, but many Sunbelt markets are well above that. If you're going into a market at 12 or 13 square feet per capita, you're likely walking into a supply glut. Second is the competitive pipeline. If there are 2 or 3 new facilities under construction within your trade area, you're going to be competing for the same lease-up customers at the same time, which destroys your ability to hold rates. Third is site selection. Visibility and access are everything in storage. Facilities on major corridors with clear signage and easy ingress and egress lease up significantly faster than sites tucked away in industrial parks. Fourth is unit mix. Climate-controlled units command 30 to 50% higher rates than non-climate units and attract a more stable, longer-staying tenant. A development pro forma that skips climate control is leaving money on the table. And finally, watch your land cost. If land is eating 20% or more of total project cost, your yield on cost math gets very difficult to make work against institutional cap rate expectations at exit. Revenue management is what separates a mediocre storage investment from a great one, and it's the area where mom and pop operators leave the most money on the table. Let me walk you through how professional operators think about this. The foundation is street rate optimization. You're adjusting your online advertised rates constantly based on occupancy by unit type. If your 10x10s are 95% occupied, you raise the street rate. If your 10x20s are sitting at 70%, you lower the street rate or offer a move-in special to drive absorption. But here's the thing, move-in specials are a tool to fill vacancy, not a pricing strategy. You have to track them carefully so you don't confuse your average effective rent with your true market rent. Now the big one, ECRI, which stands for Existing Customer Rate Increase. This is the practice of systematically raising rents on current tenants, typically by 8 to 15% every 6 to 12 months. It sounds aggressive, but storage tenants are notoriously sticky. Once someone has filled a unit with their stuff, the psychological and physical cost of moving out is enormous. Public Storage, Extra Space, and CubeSmart have all built their NOI growth engines on the back of ECRI programs. When you buy a mom and pop facility where rates haven't moved in 5 years, implementing a disciplined ECRI program alone can add six figures to NOI without a single new unit. Pair that with tenant protection plan programs, where you earn 8 to 12% of gross revenue just by attaching an insurance product at move-in, and you've got a business that compounds value every single year. Picking the right market is as important as picking the right deal, and storage market analysis has become a real science. Let me walk you through the 6 factors I look at when sizing up a market. Number 1 is supply per capita. How many square feet of existing storage inventory exists relative to the population in the trade area? A trade area under 7 square feet per capita is underserved and presents opportunity. Between 7 and 9 is balanced. Above 10 starts to feel competitive. Above 12, and you're likely looking at a market that's going to see rate compression and elevated vacancy for the next few years. Number 2 is the competitive pipeline. What's being built right now? You can pull this from Radius Plus, StoreTrack, or just by mapping building permits in the county. If there are 2 or 3 facilities under construction within 3 miles, your lease-up assumptions need to be stress-tested hard. Number 3 is market occupancy. If existing facilities are running 88 to 92% physical occupancy, demand is healthy, and there's room for a new entrant. If they're at 75%, someone already overbuilt. Number 4 is street rate trends. Are rates in the market flat, rising, or falling? You can track this over time using StoreTrack or SpareFoot data. Falling rates in a market with new supply coming online is a yellow flag. Number 5 is population growth. Storage demand is highly correlated with household formation and population growth, which is one reason Florida is such a strong storage market. We're adding tens of thousands of new residents every year. And 6 is household size and income. Smaller households, think singles and couples without kids, actually use more storage per person than large families, and higher income households can afford to store more without churning out on price increases. Let's wrap up with financing and exit strategies, because understanding how a deal gets capitalized and how you eventually get paid is just as important as the acquisition thesis. On the financing side, stabilized storage is actually one of the easier asset classes to finance. Lenders understand the business model, they like the low expense ratios, and they like the month-to-month lease structure because it means rents can reset quickly if market conditions change. For a stabilized facility, you're looking at 65 to 75% loan to value with a conventional commercial lender or credit union. Debt service coverage ratios are typically underwritten at 1.25 times, and terms run 5 to 10 years with 20 to 25-year amortization. If you're an owner-operator, meaning you plan to manage the facility yourself or through your own company, SBA 504 loans are a fantastic tool. You can come in with as little as 10% down, get a 25-year fixed rate amortization on the SBA portion, and the all-in rate is typically very competitive. We work with SBA lenders regularly here at MaxLife. So if you want to talk through a specific deal, give us a call at 321-586-2121. For value add and development deals, you're in bridge financing territory. Floating rate, 65 to 70% of cost. 2 to 3 year initial term with extension options. The lender is underwriting your lease-up model, so your assumptions need to be tight and well supported by market data. On the exit side, the three paths are sell to an institution or REIT. Once you're stabilized, sell to a 1031 buyer who needs to place capital, or do a cash out refinance at stabilization and hold the asset for long-term cash flow. The best operators cycle through all three depending on market conditions. That's a wrap on Course 15, Self-Storage Investing. You now have a real framework for underwriting a storage facility, identifying value add opportunities, thinking through ground up development, applying revenue management and ECRI strategies, reading a market, and structuring your financing and exit. If you're looking at a specific storage deal in Florida or anywhere in the Southeast and want a second set of eyes, I'm Ryan Solberg, real estate broker with MaxLife Commercial, license number 3354351. Give us a call at 321-586-2121 or visit maxlifedevelopment.com/academy to keep learning. Our next course is Retail and Specialty Properties, where we'll break down strip centers, net lease retail, and some of the more unique asset types you'll encounter as a commercial investor. Thanks for watching, and go find yourself a storage deal.